Guys, let's talk a little bit about some information that's been in the news here recently, and that's a lot of the large, well-known stock brokerage firms, investment managers paying some pretty significant fines that I know our viewers are seeing, and they may have some money invested with some of these firms, or some individuals may be wondering if my firm isn't in the news, are there still some things I should be concerned with?
Right.
So what I'm basically talking about, if you take a look at it, over the last 12 months, we've had Merrill Lynch, which of course is Bank of America now. They recently paid $415 million in a fine.
That was a record.
Right.
Yeah.
For taking advantage of their clients and doing inappropriate things with their clients' assets. If we move on to Edward Jones over the last 12 months, Edward Jones paid a $13 million fine, and then a little later they had to pay a $20 million fine for a completely different situation. But both situations were because they were doing things they shouldn't be doing, misleading their clients and taking advantage of them. And then the most recent one that we've seen here is Wells Fargo. Just paid a $185 million fine for recommending things and selling things to their clients that weren't necessarily in their best interest. And I wanted to talk about this a little bit today because I think a lot of individuals go to these firms because they're familiar with them, right? They've heard their name, they see their advertisements on TV, things like that. So they think that they could probably go there and trust them, right? You don't ever invest your money anywhere unless you feel like you can trust them. So they go to these large firms because they feel like, well, they're big, they must be doing what's right for me. But what we're seeing is that more often than not, a lot of times they're really doing things they shouldn't be doing and taking advantage of their clients. I mean, you don't pay a $400 million fine or a $100 million fine if you haven't done something wrong, right? And that big problem that I have with these fines, I mean, I guess it's good that they get themselves in a little bit of trouble. They should if they're doing things they shouldn't be doing. But the fines that they pay go to the government. They don't even go to the people that they cause harm to. So it's kind of an issue that we see from time to time. And, I just wanted to talk about it a little bit and see if you get questions about this when you're meeting with individuals in the office. And, how would you respond to somebody and explain why these companies are paying these types of fines?
Well, I mean, they'll want to know, did it affect them? And how would I be able to find out? And I think that one of the easiest ways to find out is if you're working with one of these big brokerage firms is Google something like soft dollar compensation or the revenue sharing. So if you're working with one of these big firms, I know that Edward Jones especially, they'll use a lot of the American funds. So if you have American funds in your portfolio and you're working with Edward Jones, you were probably somehow affected by this type of scenario.
Yeah, speaking of that, so what Dustin's talking about is you have all the big firms will have basically a revenue sharing disclosure. And you can basically you can Google revenue sharing disclosure and the firm that you're working with and see if they have one of these. Basically, what it is it's kickbacks. I mean, it's legal. There's nothing illegal about it, especially because they disclosed it to you. You got to go looking for it, but it's out there, so they disclosed it. And if you look at Edward Jones specifically, we know when we meet with somebody in the office, pretty much when they come in, we know they're going to have American funds, mutual funds in their portfolio if they work with Edward Jones. And the reason why is because last year, about 25% of Edward Jones' net revenue came from American funds. American funds paid Edward Jones $55 million last year via this revenue sharing agreement that they have, which basically says, hey, if you come to Edward Jones, American funds is paying them a lot of money to recommend American funds. And when you talk about situations like this, it doesn't necessarily mean that American funds are bad funds, but whether they're good for you or not, it doesn't matter. That's what you're getting. And we're picking on Edward Jones here a little bit because they got called out on it here recently, but they're not the only firm that does this, right, Jordan?
Yeah, I was meeting with someone the other week that was with Wells Fargo, and they were asking me, what's going on right now? And they said, how do these firms get away with that? It doesn't seem right. And we were talking a little bit about a registered investment advisor as opposed to a registered representative. And really the difference between those two is who your fiduciary responsibility is to. Whereas, a registered investment advisor, the designation that we have, that means we have a fiduciary to the client. We're acting within their best interest.
Yeah, well, let's explain that for just a second, because not everybody watching right now might understand that. So, when you have a fiduciary responsibility to your client, what that means is that the three of us at our firm, we have to do what is best for our client. Even if it's not good for us, we always have to show and prove that all of the recommendations that we've made are what's best for our client. A lot of the firms that we're talking about here, they don't operate underneath that standard. They operate under a fiduciary responsibility to their firm. So they can recommend things that might be okay for you, but might not necessarily be the best thing for you, and there's really no problem with that whatsoever. So it's really why we always recommend that individuals should work with an independent advisor, like ourselves or some others that are around town, and make sure that they are a fiduciary. You got to make sure that they're working out and looking out for your best interest.
There's a lot of mouths to feed at a firm like that. So what they have to do is they have to look for things that generate some fees and some back-end payments. And it's a lot like when you go to the grocery store. I mean, the shelf space. If you think about a Kellogg's or someone like that, they're going to be right there at eye level when you're looking for cereal.
Because they paid to be there.
They paid to be there.
A lot of people don't realize that.
That's exactly right. So what happens when you go to get some financial advice from a registered representative, like Jordan was saying, their fiduciary responsibilities to the firm, well, then they're going to use the things that are going to pay them that quote-unquote shelf space.
Right.
So it sometimes is just not in the best interest of their client.
Yeah, a lot of times that's exactly what happens with a lot of these brokerage firms. You own the mutual funds that you own because that was the mutual fund company that paid your firm the most money for that shelf space.
Yeah.
Right. So like we started out by saying, it really makes sense to take a look at your accounts, see if whatever brokerage firm you're working with, if they have a revenue sharing agreement with a particular mutual fund company. If they do, and you happen to own some of those funds, it's probably time to get a second opinion. Doesn't necessarily mean that there's anything wrong with those funds, but it may very well mean that those funds aren't necessarily the best funds for you to own, and you should definitely get a second opinion. Far too often we'll meet with individuals that are carrying just too much risk in their portfolio. We'll meet with individuals that have recently retired, or maybe they're a couple of years away from their set retirement date, and they have portfolios that are really more appropriate for somebody that maybe has 10 or 15 or 20 years to go. For today's segment, I wanted to cover a subject that we've covered many, many times here on the show in the past, but I think it's really important to cover it again, especially if you are retired or close to retirement. We suggest that you follow the rule of 100. And again, close to retirement is anybody that's pretty much within 10 years of retiring. Again, what the rule of 100 talks about, and we're going to go over an example or two, is it's really talking about how much risk should you have in your portfolio as you move closer and into that retirement date. Far too often we'll meet with individuals that are carrying just too much risk in their portfolio. We'll meet with individuals that have recently retired, or maybe they're a couple of years away from their set retirement date, and they have portfolios that are really more appropriate for somebody that maybe has 10 or 15 or 20 years to go. And so it's a common problem that we'll see individuals make, whereas when the stock market gets volatile, can really cause them to struggle in their retirement either almost immediately or obviously several years in the future. So here's basically how the rule of 100 works. Basically what it says is whatever your age is currently, that's the percentage of your portfolio that you want safe and protected from risk, meaning you can't lose any money. So the difference between your age and the number 100 is the maximum percentage that you could put at risk in the market only if you're comfortable with risk. Doesn't mean that you have to put it into the market or in different risk-based assets. So if you consider yourself to be a moderate or conservative investor, we usually recommend that you follow the rule of 100. So as an example, let's say that you're currently 60 years old and maybe 2 or 3 or 4 years away from retirement. Obviously, that would mean that you would want to have roughly 60% of your money safe, no more than 40% of your money at risk in the market in things like stocks, bonds, and mutual funds. So basically, the way that it works is if we want to take a look at what types of assets would be safe. So maybe even more important than understanding the rule of 100 and understanding what percentage of your portfolio that you should have safe, probably what's even more important is to understand what assets qualify as safe investments. What are we talking about here? So some obvious things that you can probably think of are going to be anything like CDs or just different money market accounts, savings accounts, things like that that you can find at the bank. Not going to make much money on them, but again, you're not going to lose anything on them. Other assets that you could say are safe are maybe going to be different government bonds, obviously U.S. Treasuries. As long as the United States doesn't cease to exist, you could argue that government bonds are going to be safe. You have certain types of annuities. So you have fixed and indexed annuities that could be qualified as safe investments. As long as you have enough time before you need to withdraw all of the money out of the account, then you don't have to worry about losing anything. So we have a few different things that could be considered safe. These are some of the more common asset categories that we usually will recommend when someone's wanting to take less risk with a portion of their portfolio. Obviously, other things then would fall into the risk category. So pretty obvious things that are going to be risky are going to be stocks, maybe different types of bonds. You know, some government bonds you can make the argument are safe, but other bonds are going to carry some risk, maybe from default or interest rate risk, things of that nature. Any type of ETF could maybe be considered risky. A diversified mutual fund portfolio would still have to be classified as a risk-based asset. And that's a really important point. You know, a lot of times individuals will try and say, well, Matt, my portfolio is diversified, so therefore, you know, I feel like I'm pretty safe. Or they might say things like, I've got a mixture of some stock funds and bond funds, so, you know, therefore I'm meeting the definition of what you're suggesting. That really isn't the case. Anything that has the potential to fall in value, you have to put on the risk category of this particular example. And then again, if you were 60 years old, you'd want to have no more than 40% of your assets tied up in things like that. So it's important to follow the rule of 100, but I think it's also even more important to make sure that you have the right asset categories and you have the appropriate percentage in things that just cannot go down in value, really no matter what the economy throws at us. And obviously, like I've said in the past, whenever we start to talk about the rule of 100, you don't have to hit the percentages exactly. What you want to try and do, though, is be close. You know, if you're 60 years old, you could maybe have, you know, as much as maybe 50% at risk or 30% at risk. You know, 5 or 10 percentage points one way or the other is fine. However, if you're within 10 years of retirement, I wouldn't go much more than 10 percentage points away from this particular rule. One of the things that we talk to individuals about all the time is that as you get closer and into retirement, one of the most important things you could do is make sure that you don't take losses, because what's going to happen is a loss is going to hurt you a lot more than a gain helps you as you move closer and into retirement. So
This week in the office, we had an interesting case that we wanted to share with you guys. We had a couple, John and Sally, who had experienced some pretty large losses back in 2008, and moving into retirement, they just didn't want to go through that again. So Matt, can you help walk us through what we can do to try to achieve that?
yeah, you know, a lot of times we'll meet with individuals where they've experienced big losses in the past. They're now going to retire, and they just say, well, how do you do this? You know, I can't go through another 30 or 40% drop like we've seen in the past.
Right.
But at the same time, I don't want to invest my money in savings accounts or CDs because
Right.
they're just not paying anything. That won't generate any income. So how is it that we go about it? One of the things that we talk to individuals about all the time is that as you get closer and into retirement, one of the most important things you could do is make sure that you don't take losses, because what's going to happen is a loss is going to hurt you a lot more than a gain helps you as you move closer and into retirement. So, Dustin, if we look at it like this, you know, we get the question all the time where individuals will ask, you know, what is the stock market going to return as far as a percentage over the next 12 months?
Yeah.
And obviously, neither one of us have a crystal ball. But we do know, if we were to take a look at the 100+ year history of the stock market, if we were to kind of, you know, plot on this line each year, we know that the majority of the time the stock market's going to be somewhere between a 25% gain to as much as a 25% loss. Now, obviously, we've seen it like 2008,
Sure.
where sometimes the market loses more, and then occasionally when times are great, sometimes it'll earn more than 25%. But the majority of the time, probably 90-95%, you can say during the next 12 months, we pretty much know the returns are going to be somewhere between these two numbers. For most, especially as they get closer into retirement, that's too large of a range.
Yeah, you can't do
right?
real planning with
You
that.
can't plan on that, right? Because this is going to hurt you really bad, and the chances of that happening aren't very good. So individuals say, well, that's just too wide of a range. Where we want to live with our clients, when we start talking about not losing money being the most important thing that you can do, but you still need to earn a reasonable return, what we want to do with our clients is we want to basically live right here. Somewhere between 0 and 15 is kind of where our threshold is. We want to draw the line in the sand and say, you know what, we're not going to lose any money, but we still need to earn a good, reasonable rate of return, maybe up to, in the really good years, maybe we could earn as much as 15%. But one of the things that's important about this, whereas we talk a lot of times, we're not a perfect fit as a firm to help everybody, what you have to understand is in order to provide this safety, what we're really doing is we're giving up any potential for that. So when the market does great, we're just not going to participate. And when we eliminate the potential for that, what we can pretty much do is eliminate the potential for that.
Right.
Okay, or even if we had losses, maybe they'd be very, very small losses. So the majority of our clients want to basically live somewhere in between these numbers. What that ends up equaling over time is maybe an average return of somewhere between 6 and 8%. So individuals, as they move closer and into retirement, they can't ride this big roller coaster. You know, you don't want to have big losses followed by large gains. What you want to do is draw a line in the sand. If you never take on losses, you don't have to take a whole lot of risk shooting for very high returns because you're never digging your way out of a hole. And it sounds pretty simple. Obviously, it gets a little more complex than that. But that's kind of the mindset that individuals have to start focusing on as they move closer and into retirement.
Thanks, man. And that was this week's Scenario of the Week. If you have more questions about how you can accomplish this, please feel free to call our office and or visit our website.
Now, investors will often see this trend and think the bear market's over. Then the behavior kicks in where they don't want to miss out on the gains, and then they buy back in right before things to head back down again. On this segment of Strategic Wealth University, we're going to be talking about bull markets and bear markets, the difference between the two, how to spot them, and how a portfolio can be positioned during these different economic climates. So first off, what's a bull market? So a bull market is where a market is rising or is expected to rise. This in turn creates and promotes consumer buying, which continues to rise the price or the overall market index. Now, if we flip that on the other side, what's a bear market? So a bear market is where a market is falling or it's also expected to fall. Now this in turn creates and promotes consumer selling, which continues to lower the price or the overall market index. Now let's take a look at some past scenarios where bull markets have occurred. If we look back at 2000, we have the dot-com bubble. So after this followed a bear market. If we look back at 2007, 2008, we have the real estate bubble. And following, we have a bear market. So if we look at 2014, 2015 area, we have a bull market caused by a variety of factors. Now looking at the market climates, we can start to see a pattern emerge. We see a period of a bull market followed by a bear market. And what happens is yet to be determined for our current economic cycle, but if we look at past historical data, it's safe to say that another bear market is soon to follow. So something that we talk about is the likelihood of a market correction happening. Now a correction on average happens every 7 to 8 years. In the 7th year, there's about an 80% chance that the market's going to go through a correction. And in the 8th year, that number jumps up to 90%. So we only have a 10% chance of generating a positive return in the 8th year. I don't know about you, but there seems to be so much more risk than there is really reward. Now, something that's very interesting is how these cycles, or bull and bear markets, travel, meaning how they move up or down. Now, a major misconception, especially for a bear market, is that it moves only down, meaning that the only direction over the term of the bear market is that only moves down. Now, what we see from past historical corrections or past bear markets is that there are and have always been wild upswings too. There could be a 15% downside correction followed by a 5% upside correction, followed again by a 10% downswing. Now, the most important thing to take away from this is that the 5% gain doesn't always indicate that the correction is over, and it is extremely difficult to time these brief or minor upswings. A lot of investors make the mistake of buying back into the market towards the peak of these minor upswings, and then as soon as the buyback or as soon as they buy back in, the price level or the investment continues to fall. In this instance, it is really important not to try and catch a falling knife. If you see that something's falling or it's probably heading that direction, it's best not to guess its floor or predict its bottom, because more times than not, based on statistics, we are not going to be able to consistently and accurately determine the floor of an investment. Now, bull markets are a bit more predictable, and while there are seemingly continuous upswings, there are some downticks as well. But the key thing to take away from bull markets and bear markets is the trend. I know we're about to have some graphics come up, so let me go ahead and explain these. In this first one, this is an upward moving bull market trend. Now what do we see? We see an upswing, a small downswing, but the bottom point or the change of direction is never lower than the last uptick, meaning that each time there is an upward cycle, we're still higher than we were before. Now let's go ahead and flip the graph. I want to take a look at a bear market. So we can see from this that there are continuous down and upswings. But what we can take away is that each time we have a brief upswing, it is never higher than the previous downward point. Now investors will often see this trend and think the bear market's over. Then the behavior kicks in where they don't want to miss out on the gains, and then they buy back in right before things to head back down again. So again, if we look at some numbers, we can see that the average investor cannot effectively time the market. The best thing to do when we're riding the roller coaster, so to speak, is to first and foremost consider getting off the roller coaster to avoid further drops. And also one thing we really need to try to do is to maintain patience. Now what comes to mind? You think, all right, I have this information, but how do I position myself for a bull or a bear market? How can I achieve safety but at the same time see a reasonable rate of return? Now in bull markets, equities or stocks typically will have reasonable returns. During a bull market, to fully capitalize on the upswings, a portfolio will help maximize itself by having stocks or equities. Now on the flip side, what do we do when we have a bear market? First and foremost, we have to have a properly allocated portfolio, meaning that we need to have a large portion of our portfolio in investments where we never have to worry about losing anything. Something like this could be a CD. For something with some more potential upside growth, an annuity could also be an option. Now the portion of the portfolio that we have more upside potential for, that we've decided that this is the portion where we can have some risk or take some risk. We could have stop losses on those positions. Now this enables us to sell out of the portfolio or each holding at a certain predetermined price that we determine. So really understanding past historical bull and bear markets is vital for determining when to invest and really when to get out of the market. If you would like more information about how Strategic Wealth invests in and during these economic climates, please give our office a call or feel free to check us out on the web.